Good day, ladies and gentlemen. Thank you for tuning in. Our next presenter is Steve Lovely, CEO of Ackroo. Mr. Lovely, you may begin.
Great, thank you. Well, welcome everyone. Thank you for your time this afternoon. I'm going to spend about 30 minutes today going through a bit of Ackroo's history, some of our progress, some opportunities that we have, and then most importantly, some plans we have into 2021 and beyond. And as mentioned, I am Steve Lovely, CEO here at Ackroo. I'll start off with a bit of our story on even our name. The name Ackroo actually comes from the word accrue. It's an accruing, customers and rewards, and the definition in the dictionary is it's to accumulate or be added periodically. In the first years, we had used that name after acquiring a company out of Vancouver called Moneybar. The thought being, let's accrue customers and rewards. But over time, what the goal of Ackroo has been, it's changed. We've been more focused on accruing companies. And accruing offerings to help our merchants. And over the years, we've accrued gift card and loyalty and marketing and data, payments, and then most recently point-of-sale companies. So it's an accruing of businesses, and I'll talk today both about our organic business, but the big story of Ackroo thus far has been our inorganic business and the consolidation play that we are playing in the marketplace. From a vision standpoint, our vision all along has always been to, consolidate, simplify, and improve the space. It's a very fragmented industry, the gift, loyalty, and payments ecosystem. So we've been putting a lot of effort into consolidation, but we've also been putting a lot of focus on simplification. Not a simple product, but a simplified product. So taking the complicated and simplifying it down, and then making it easier to use. So improving the usability of it and the effectiveness of it. But from a mission standpoint, we're doing both vendor and industry consolidation. So we're consolidating, offerings for our merchants so they have one single client to deal with, but also our direct competitors. But the focus of Ackroo from a mission standpoint is using technology. The core of what we are and the core of what we do is a technology company. Everything we do all goes back to our tech, and it's a technology-driven business. We're not a services organization, we're a technology-driven organization. And what's changed over the last even 12 months of the business is we've moved from not just providing a marketing platform to merchants, we've now added payment and point of sale. So we really have three solutions here at Ackroo. The first, again, is our marketing platform, which was our core solution, which is our loyalty, gift card, and promotional transaction platform, which is a very data-driven solution set. We've recently bought a payment company, which brought us into payment processing. So we're now a reseller of both First Data and Global Payments and all their technology and services. And we also have point of sale, but specifically point of sale into niche markets. The first niche market we chose was golf courses. We saw through things like COVID as an opportunity there. So we're going after niche markets from a point of sales perspective as opposed to a generic strategy. To really understand, our approach, there's kind of three kind of things that we look at ourselves as being a market leader in. The first is consolidation. This is how we're different. We've bought over 10 companies in the last 6 years, so we are a market leader in that capacity, with a real focus on the small to medium-sized landscape in the payments, marketing, and point of sale. But a lot of what we do is also innovation. We're taking all of these solutions and bringing them together from a data-driven perspective, going after these niche environments, but innovating our product on a constant basis. As a SaaS business, what customers are paying for on a monthly basis is that constant evolution of the product. They're paying you monthly fees to constantly give you version 2.0, 3.0, 4.0. So we're in constant innovation mode here. But how we create innovation is through integration. We do integration of our own platforms to each other, but also to other solutions. So integration is really also the real heartbeat of what the technology is doing and why we're a little bit different. We've decided to diversify ourselves across 4 key verticals: petroleum, hospitality, automotive, and retail. It's played really well for us in times like COVID, where, yes, we've seen a lot of areas of attrition, like retail got hit pretty hard this year, and hospitality from an industry perspective. But that balanced approach has allowed us to kind of, balance out, tough, difficult times, but also get specialized in different areas. So we've created a specialized approach to each one of these verticals. So single back end, unique front ends each time. From a benefit standpoint to a customer or to a merchant, there's many. From a gift card standpoint, loyalty and marketing platform side of it, it's the root of it, but it really all drives back to data. We've been capturing data for a lot of years in the business, and now we're actually taking that data, finding better and more important ways to present it to our customers, and then giving them tools that can action that information. What a loyalty program really is allowing customers to play big brother. And you know, what you're signing up for is the ability to kind of give them your spending behaviors, but in return you get rewards and promos. We have all this data information to help drive better initiatives for our customers to kind of create growth. So we saw that as the birthing of our business, and that is the core of what Ackroo is today. And that's where a lot of our growth will come from. But what was also important for us was adding, you know, necessary complementary solution sets. Things like payment that every businesses need, and things like point of sale that is the actual general operations of a business. So these are core necessary functions of a business. So now we have fantastic complementary solutions like our marketing platform, complemented by a great payments offering and great point of sale solutions. From a revenue perspective, we've done well. You know, we started the business in 2012 through an acquisition. We took a business that was, you know, about 8 years old and it had climbed about a $500,000 business. We did a bit of growth in the first year, but really we took the company public was the focus. Taking the company public and creating enough capital in the business to kind of grow it. And we've steadily grown the business year over year. And we've seen, you know, steadily, you know, both from a recurring standpoint and a one-time revenue standpoint, steady growth. Where the only year that was kind of a bit flat was the year in 2014 when I took over. I was not the founder of Ackroo in 2012. Another group was. I was brought in as a consultant to the business. Spent the first 2 years in the sales and marketing leadership role, getting to know the customers and the partners. But I was tapped on the shoulder in 2014 to, you know, start over, if you will, both from a go-to-market strategy, where we changed from being a direct sales model and really just a business that wasn't really adopting things like the consolidation play to a really big channel sales model and a consolidation play. That growth has really played well for us, but now we have over $5 million of annual recurring revenue in the business and growing. So our revenue growth has been great and steady through both organic and inorganic means, and we think it's going to continue for us. From an earnings perspective, we've steadily climbed out of, you know, the startup world where we've had lots of losses early on, and in 2018 was a big turning point where we actually turned the business to EBITDA positive. Through a combination of organic growth and inorganic acquisitions, we turned the business to profitability. And you will have seen now in 2020, we're trending to be, you know, within 2 years, we will triple our earnings. So we've gone from 2018 to 2020 and already tripled our earnings, and we see no reason why we won't, you know, have 5 times the earnings within the next 2 years. So the earnings growth has been continuous and steady, and we think that's going to continue for the business because it is a very high margin business. Financial highlights for our business is that it's high retention rates. You know, 95% of our customers are retained on an annual basis. It's software, but a part of our acquisition strategy does play into that. Our clients are not only sticky to us, they're sticky to our competitors. So part of the acquisition story is around that. We have large gross margins and a lot of recurring revenue. We've had an 51% EBITDA CAGR after the first year. That will increase this year and in the future years, hopefully. Our revenue CAGR has been strong. Our EBITDA margin, we're already trending at 20%. And our goal as a business is to maintain that. You know, how do we maintain, you know, 20 cents every dollar contributing to EBITDA margin? And we believe we have a business model that plays into that. We have rules in the company, like a revenue per employee model for hiring, to sort of make sure we have that financial diligence in place. And we run a very tight financial ship here. We did a raise recently that allowed us to do our last acquisition, and it's also now put some cash in the treasury. So for the first time, we have a very healthy balance sheet with over $1.8 million of cash in the bank account at the end of 2020. It's the most cash we've had since I've taken over in the bank at one time, which is just a sign of the health of the business as we keep on increasing that cash flow over time. And the big thing is that we've proven that we know how to close deals. We've closed 10 M&A deals so far. It's a very, very fragmented marketplace, and we'll talk about that in a minute. But we've done well, and we've already gotten 10 of them acquired and normalized. So in talking about the milestones, a lot of them are around our acquisitions. So I mentioned about, you know, early on that it was an RTO that started the business. It was an RTO of a mining company and a technology company together. We rebuilt the platform, and then I took over in 2014 with a big focus on acquisitions. So a lot of our story was acquisitions along the way, getting us to EBITDA positive, and then adding extra offerings like payment and point of sale. I look at the market as 5 pieces of the pie. The gift card and loyalty market is kind of where we started. It's the foundation of us. There's lots of other players in the marketplace that started in other parts of the quadrant. Some people started as point-of-sale companies. Others have started as payment companies, marketing or data. We chose to start as a gift and loyalty provider, and it's the strength of what we are still today. But all 5 pieces are important pieces to the ecosystem from a merchant perspective. For us, again, gift and loyalty is the center of what we are, but we do marketing and payments and point of sale and data. But the future is shifting for us, where we've been embedding data into our platform, where we become a much more data-driven solution set. Yes, we'll provide gift and loyalty, and yes, we're providing POS and payment and marketing solutions, but fundamentally, the data we're providing is the key to, power of value to our merchants. We're doing two things in that, one, not only are we providing data back to their business, they know how to engage and assess their business, but also there's a network effect where we have data points from all of our customers, so we can give comparative data. We can allow our customers to know how they're doing it against the average across all merchants within the Ackroo network. So there's data for themselves, but data across the network. That's a big value to our merchants. So I mentioned we kind of have three business strategies. We have our payments business, our marketing business, and our point of sale business, with marketing, again, being the center today, focusing on all the insights and administrative tools that we have. But really, from both our two platforms, it's really about creating a generic backend with unique front ends. So the generic backend for point of sale, we have through the acquisition of GGolf a little while ago. It's a very basic POS, so we will either be rebuilding it or buying another POS company to become that backend for us. But what's great about that solution is the front end, that management system that's specific to the booking system, the tee time system that's used at golf courses, and it's a marketing leading solution that's there. So we'll be doing a lot more of that in the future. So same with on the marketing side of it, it's really having a very stabilized back end with unique front ends by vertical or by sub-vertical. The addressable market is quite big. They say it's a $180 billion marketplace and growing. If you think of it yourself, gift card sales, especially this year with COVID, they're thriving. Not just digital gift cards, but gift cards in general. It's an easy gift to people. The gift card business is thriving, but loyalty is thriving as well. Businesses are trying to better understand their customer behaviors so they can steer them and engage them and really retain them. So there's a lot of growth in these areas. What we've done really well is in Canada, specifically in areas like automotive and petroleum, where 1 in every 5 dealerships in Canada is now using our software. So when I say automotive, I mean automotive car dealerships primarily, but also automotive services companies. When we say petroleum, we mean gas stations and quick lube. And we say hospitality, we mean quick service restaurants, table service restaurants, and hotels. And then retail is kind of the catch-all for everything else we provide. And that's the part of our industry that did get a bit hurt this year. It's the stadiums, it's the movie theaters, it's the specialty retailers. So retail makes up the rest. But as you can see, we've done well in these two niche markets, and we're going to continue to sort of double down in those areas. From a client perspective, we have over 1,500 clients now at Ackroo across over 5,000 locations. So we're growing steadily, and it's very diversified across our customer base. But if you think about how it's spread, we now have large merchants, small merchants, and medium-sized merchants. But you're seeing double the logos in the medium-sized merchants because that is our focus point, and that is our sweet spot as a company against many of our peers. It's focusing on those mid-market brands that require a little bit extra advanced technology from a loyalty and gift perspective. It's not enough to get your base POS system that has a basic loyalty and gift solution. They want to have a more of an enterprise solution. But it's not as custom as some of the large brands are looking for. So there's that sweet spot in the middle where it's customized as opposed to custom, and as opposed to SMB that we're really focusing on as a business. And everything we do here technically and operationally is to drive that mid-market brand while also supporting our large brands and our small brands at the same time. We're doing a lot of self-service advancements to our business to support those small merchants while also addressing the large. A lot of partners are what drives Ackroo forward. This is where a lot of our lead gen comes from a partnership perspective. So a lot of our success has been through the partners that we have at Ackroo, and this is where they're integrated and they're referring to us. From a business model standpoint, there's really 4 parts to it. We have a one-time setup fee, whether you're getting on our marketing platform or POS platform, ranging from $250 to $1,000 if you're on the marketing side, or $3,000 to $5,000 on the point of sale side, depending on the number of days it takes. Whereas payment, there is no cost to set it up. Our customers will take a monthly subscription fee. Like I mentioned earlier, they're paying a little bit of money for a long period of time to have escalating the actual platform for them. With our smallest clients paying us $25 a month, and our largest clients paying us $1,000 a month per location, which is based on full POS and all the service offerings. But as an average across all current merchants today, our average recurring revenue is $83 per location per month. We then have variable subscription revenue that comes into the business through our payment and POS residuals. So when we actually introduce our clients to debit and credit services, so get your Visa and debit rates through Ackroo, we get residuals as commissions. It's a straight margin commission that comes to us. There's no cost of goods sold at Ackroo. And so with that, it becomes another recurring revenue stream for us. But we do have one-time revenue that we call product revenue in our financial statements, which is, when we do email and direct mail marketing, when we sell additional collateral like, cards and key tags, when we do custom development. And on average today, it's about $16 per location per month is the revenue we're driving. I mention this because, as you can see, we're getting about $99 per location per month across our customers, give or take. And so knowing that the average is $99, but our opportunity is $1,000, shows a 10x opportunity within our own customer base. Now, we're not going to have every customer paying us $1,000 a month because the offerings may just not justify that, but it does show a path to $100 a month today is our average. When the top of our customers is $1,000, there's a big path to organic growth. On organic growth, we kind of have, from an approach standpoint, three ways. The first is through cross-sell, where we take our customers through a journey. All of our customers on the marketing platform are gift card customers, with only really half of them being in loyalty. So we work them through the whole chain of gifts to e-gifts to promo to loyalty to marketing, and then hopefully introduce them to payments and then point of sale. And if you think about the opportunity for us, 82% of our clients are in marketing, 10% of our clients do just point of sale, and 8% are using payment. Only 1% overlap those three offerings. So there are 99% of our customers that need to be introduced to the other offerings. So a massive cross-sell opportunity for us that we've got within our own customer base. Our technology has all been about integrations and expanding product sets and centralized solution, like I mentioned earlier. But from a geography standpoint, there's another opportunity for us. 93% of our revenue comes from Canada today. And if I showed you a heat map even of what we did last year, the gross majority of wins that we had were all in Canada. We do have sprinklings of wins, and we have clients in California and in Texas and on the east coast of the U.S., but really, it's a really untapped opportunity for us that in the future we're going to spend a bit more time on. We have, ability to integrate it there through our technologies today. It's really just a sales and marketing focus and approach area that's next. I mentioned earlier that our story is really about inorganic growth, and that has been the legacy of Ackroo. We've done 10 deals so far, all of them being, we believe valuations that were good and fair for the business. For the most part, early on, a lot of stock was used because that was the only capital we ever had access to. But over time, we eventually used cash. And now that we have access to cash, the hope is to keep doing that through cash and earnouts within the businesses. Integration time being a big factor here. The faster you can acquire and integrate and be able to kind of get those normalized dollars back in your business, the better. So we've done that with a lot of revenue acquisition and customer concentration acquisition, but there's been other wins. Like every time we've done a deal, there's been other wins, whether it was getting to gift card fulfillment or doubling down onto automotive, getting into mobile, getting into petroleum, getting into business intelligence and digital marketing and payments and now POS. There's always secondary reasons to every deal that we believe is helping push us forward. Inorganically, we're going to continue that path. We'll always do a couple a year. All of them, we look for them to be accretive where we're adding, customers, tech. But in this future, it's a lot more talent acquisition. Historically, we've rarely kept very few of the staff that we've acquired in the past. But as we're growing and we're at that point of scale, we need to start adding some better talent into the business who are more talented in the business. So be a focus on talent. Normalizing within those 12 months like I mentioned before, but really for us, the secret is for every dollar of revenue we grab, we want 40% of it to contribute back to EBITDA. 20% to maintain that EBITDA margin goal that we had before, then 20% back into the core business to kind of accelerate everything across the board. So if we keep doing that, we keep that, that 20% contributing right back into the business and then 20% back through EBITDA margin, we feel like we've got a strong business. But the sweet spot for us is that small to mid-market business, that less than $5 million a year business that most companies are not acquiring. A lot of big guys in our space are acquiring as well. We're not new to that concept. But the sweet spot is those smaller businesses that people aren't really going after. Lots of competitors across gifts and marketing and payment and point of sale, and lots of people that are, consolidating, but the bulk of them are private. So you don't hear about a lot of them, but you will hear about some of them. Some public markets peers that I thought I'd throw out are companies like, Amian, Lightspeed, and Shopify, and Par and Quorum. These are all peers to us. Now, they've all gone at the market from a different angle. Lightspeed's an example of these are out with point of sale. They're specifically into hospitality and retail, whereas we started with marketing. And only are now getting into point of sale, and we're across 4 verticals. But we do see the success that they've had, and we see that potential success for ourselves. We just come at it from a different angle, and it's been a slower path to get there. But we do see this whole industry has done really well. We all took a bit of a hit earlier this year from a share price perspective, and but from a business perspective, most of us didn't get hurt. Us at Ackroo, we didn't have to get any funding from the government. We've been totally stabilized. We didn't lay off any staff. All of us have survived, and most of us have actually thrived through times like COVID, which just shows how strong our industry is and how resilient we are as a business for the merchant ecosystem. So from a differentiation standpoint, we're a vendor and industry consolidator for all merchants. It's really how we're different. Our diversification, our breadth of offering, our platform being, data-driven and niche. We've remained affordable for all merchants because all of our pricing is kind of per location. Our public currency actually does play into an asset for us. So when you're acquiring a business, if you're acquiring a business and I have public market shares to give, there's a value there. Whereas if I was a private provider, I really can't give any paper. So if we are to ever issue paper, there's value in it for the actual people that we're looking to acquire. If you're an investor, we do have market leadership. We're doing a lot of the things that people talk about, it's cloud-based and it's a SaaS solution. We are omni-channel. We're both brick and mortar and e-commerce. We're playing the payments and big data and digital, but we've proven ourselves. We've proven ourselves that we know how to integrate and operate these smaller businesses. We've done so in a very large market, and we continue to grow all the way through it, both revenue and earnings, and we believe at an attractive valuation when we look at some of our peers that are out there, both in the private and public side of the markets. From a share structure and ownership perspective, we have just about over 100 million shares outstanding, so it's actually very similar to the peers that I showed you before, and around 100 million shares issued. We have about 7 million share options granted right now, fully diluted about 145 million. At the end of December, we were trading at 19.5 cents on the close, so that's why you see $20 million market cap here. From a saturation standpoint, 30% of those shares are held by the board of directors and myself. And there's 2 insiders that have another 30%. So there's really 60% of the ownership across the board, management, and 2 insiders. The rest of the float is what's out there. The team consists of myself and my colleague, Derek, from a finance perspective, and we have our 6-person board of directors, where we've recently even added another director in Francis Shen through our last financing to round out a number of skill sets. So now we have, corporate securities, we have accounting, we have technology, we have capital markets, and now also M&A expertise. And we're going to continue to sort of expand on things from there. So I'll finish with, again, really the goal of Ackroo is that consolidation and improving the business, but it's that simplification of technology, simplification of an industry that just keeps changing and moving. And we really believe that we're on the right path, and we're going to see big returns for our customers, but also for our investors, because we do see a big growth path ahead. I'll stop there, and I'll leave the floor open for any questions. So first question is by Mark Boucher. I'm fairly new to this sector and a recent new shareholder after taking that Mr. Shen as a shareholder. I did invest a while back in the company Snip Interactive with Sun Venture, which I'm not a shareholder anymore. The question is that company similar to yours? And could it fit into your business model and possibly an acquisition? Best regards. No, Snip's gone after a different part of the marketplace. So I am familiar with them. I know that they're Toronto-based here, but they've gone after more of a brand-specific rewards or loyalty kind of scheme. What our loyalty schemes are more, and marketing platforms more geared towards is the merchants themselves, not the individual brands. So there's a few companies that do a lot of loyalty stuff for brands, whereas ours is actually for the merchants themselves. Next question is, what are 1 to 2 things investors should look for in 2021? I think from my perspective, you're going to see the continuous acquisition of a couple more businesses. We're going to be doubling down in the 3 verticals that we've had. So there's some very accretive deals in front of us. COVID has played well, where there's people that are looking to sort of move on. So you'll see the acquisition funnel move. But you're also going to see a lot of organic happen this year. We had a record quarter in Q4 as a company. So record revenue, record new customer adds. So organically, on top of inorganically, we're thriving. So a great combination of some solid organic growth this year because our team is actually getting bigger and stronger. And secondly, the acquisition train should keep going. Next question is, how easy or difficult is it to integrate the acquisition? You have so many acquisitions, it will come to a point when you can manage, digest all of these acquisitions, all these businesses complementary, and finally do you see yourself as a roll-up business in the gift card loyalty business. So yes, we're definitely see ourselves as a roll-up, so much so that our industry sees us that way, where there is more companies that reach into me than I reach out to. So we've actually hit a tipping point about a year ago where I actually have more inbound requests about looking at their business than I do outbound on M&A perspective. But every acquisition is a bit different. Our goal is to do it within 12 months, and you are correct that they are challenging and difficult, but every one we do, we get smarter. We get better each time as we kind of move along. And so for us, it's getting that system where within the first 90 days, how do you integrate all things operationally and financially? And then the next 90 days, how do you engage the clients and administration and marketing? And then the back half of the year, how do you do everything technically? So we've built a model that we believe works, and it's paid well for us. That's helped us to sustain and actually grow these customers. Last question is, every time you acquire, are you diluting the investor investment by adding shares to give out? As you saw earlier, we actually haven't been issuing many shares over the last few years. It's been very cash-driven. So there was a lot of equity given early on because that's the only capital that we had access to. But for us, we have a better cash position where two things are happening. One, we actually have cash on treasury that we can use. But two, as in our stable business, there's a lot of businesses that are looking that don't feel as stable, that are willing to kind of, move on, and even in an earn-out strategy. So we're not looking to take on heavy debt, even though we do have some debt in the business. We want to keep our debt to earnings ratios well below that 4-to-1 ratio, and I think we're at about 3-to-1 right now. But it's really making sure that we're growing without dilution, that everything is accretive, where, we may, if we have to dilute 10% of the shares, it's because it's going to help us grow the company by 20 or 30% from there. I think there's any more questions? Okay, well, looks like that's all the questions for today. I have one-on-one set up with several investors this afternoon that I'll speak to, but my contact information is on the presentation. You can also go to our website, and you can see the investor deck that I showed today when you go into investors and look for the investor presentation. My contact information is there. Best way to reach me is always by email. Very accessible to answer questions and get back to you. We don't actually have an investor newsletter or email group because at this time I'm pretty responsive on emails. So that is the best way to come back and ask me more questions. Happy to set up time, a half hour, an hour with people to kind of go through what we're doing and where we're going. But we're excited about our growth. And thank you for your time today, everyone.
Thank you. That concludes the webcast. We appreciate your participation and have a nice day.